Hello and welcome to a Major Market Movements video blog update for October 30th, 2014. In this video blog, we're going to cover some of the technical signals that are indicating a possible significant or major top in the stock market. One of the first indicators to look at that I like to look at is this breadth indicator, and it's comprised of the 52-week highs for individual stocks minus the new 52-week lows in the New York Stock Exchange on a weekly basis. And so this blue line that you see here is that calculation, and the lines are connecting those points on a weekly basis. And you can see, I need to tell you that this Bollinger Band is a 52-week moving average with a 2.5 standard deviation. So this keeps track of the larger trend and shows the extreme moves in the market, whether it be to the downside or to the upside. So put it all together, we come up with a very good indicator of extreme sold conditions, extreme bought conditions, some negative divergences between the price and what the overall breadth of the market is doing. So if we go back here to the 2007 top, this is the SPX, the S&P 500 index. You can see that the SPX was moving up in price, but the breadth of the market, the number of new highs versus new lows, 52-week lows, was dwindling. So the participation rate of this move higher was shrinking, even though the actual price is moving higher. Basically, you have fewer and fewer stocks carrying the water for further upside, while there's more and more individual stocks creating new 52-week lows. And you can also see that play out here with this brown line here. This is a 52-week average that right around this top here started to dive downward towards the zero line. Now the zero line is right about here on my cursor. That zero line basically indicates that when the 52-week average gets to that point, the market, the majority of stocks is experiencing 52-week lows on a consistent basis, far more than stocks are seeing 52-week highs. So, and if that persists, you can see right around here, we got the bearish crossover where the 52-week average dipped below the zero line. And it was right around here that we had our last final lower high before the market started to move into this tumble. Now, we did get a warning shot. We had an extreme oversold condition with the indicator moving below the 2.5 standard deviation of the Bollinger Band here on a weekly basis, right around here. And that was our warning shot. That was an indication in the market that this market was willing to move to oversold levels that it wasn't comfortable with before. You can see back during this uptrend that the market, the breadth indicator, was bouncing back and forth inside the Bollinger Band during this uptrend. And it was right around here that we got our first basic panic sell at the top of this previous uptrend. This was the warning that this market is probably getting toppy. We may have sealed in a significant, if not major top, and we better be looking for protecting ourselves to the downside, because this market doesn't look like it's going to, is not set to recover very quickly. And sure enough, it didn't. It bounced sideways for a while, and then we saw the big sell-off during the Lehman Brothers crash. So years persist, and we get this as the market started to sell off. We started to see some lower lows in the market, but you can see it started to develop a positive divergence with the breadth indicator. We got lower lows in price, but we started seeing higher lows in the breadth indicator. This is a sign of the market wanting to recover. And sure enough, it did right around early part of 2009. We did find a bottom, and the price started moving upwards. And you can see the breadth indicator started moving sideways back inside the Bollinger Bands. Except there was a few times where we didn't see incursions during this uptrend that was not experiencing all-time highs yet, where you did see some panic buying right around during the top. Right about here, we saw a panic buy, and then we see a correction, a more choppy sideways movement. We did see a warning shot right about here, and this would have been a cause for concern. This warning shot, however, did not occur during all-time highs, so it's not as strong as a indicator if we had been experiencing all-time highs before this warning shot. That warning shot only fell and caused a correction for a few months, and then the market recovered again. You'll notice that the 52-week average came down to the zero line, did not cross over it, basically kissed it and bounced back up. We saw another panic buy right about here. It forced a correction, and then the market started climbing again. And you can see that the breadth indicator started oscillating back and forth inside the Bollinger Band. Until about May of 2014, we started seeing this, well, actually about the beginning of 2014, actually, right about here. What is that? That comes to about, okay, October of 2013. We started to see the market, even though it was cruising up higher, we started seeing this negative divergence show up again, where the price was moving higher, but the breadth indicator was moving lower. And now we're back up to a warning shot coming off of previous all-time highs again. So this is an indication to me, coming off of all-time highs, it looks very similar to the market movement that was taking place during 2007. So this is suggesting to me that this market may be petering out, that the sloping line, this 52-week average, is sloping to the downside again. So this is a warning signal that this market could be getting toppy again, and we need to be careful of being long and actually be thinking about putting on hedges or active short positions when the short-term trends look to be topping out. So that's just one indication. Let's move on to another. This is the swing low indication. Here back in just before the major top in 2000, we had this crash, a 25% drop back here in 1987. And from that swing low, we started seeing a recovery. And we started to see this with the first higher low here. We continue to see a string of higher highs and higher lows well into the 2000 top. And this was obviously the dot-com bubble, and it topped out in 2000. And the first swing low, we'll zoom in on it. The first swing low here, we saw a lower low for the first time since basically 1987. So that was another warning sign that the market was toppy. And sure enough, as the months progressed, we continued to see lower highs in the market and lower lows into a downtrend. And that persisted up until 2002, late 2002. And then we'll move a little bit further in time here. And then after that late 2002 low, we did see our first higher low again after this downtrend, and the market took off again, creating higher highs and higher lows right up into the major 2007 top. And so right about here in early 2008, we saw a lower high, which was confirmed with a new lower low, the first lower low, and that set into motion another multi-year downtrend, which was the real estate and banking bust of 2008. So we'll progress a little further into this new uptrend after that trend. Here's the uptrend, basically I don't know what you want to call this bubble, whether it's the Fed bubble or the U.S. government bubble, however you want to look at it. We did see after this last lower low, we did see our first higher low, and the market has taken off since. And right about here, we've seen what looks like our first lower low in this market. So this has increased the probability that we may have a major high right about here with this last higher high. So as long as that level holds, and that high currently is at 17,350, this dynamic is in place. So that's our swing low analysis, and that's another indication. That's basically sign number 2. Let's move on to sign number 3. Here's our 2007 top again, and you can see right into the 2007 top, we started to see a weekly divergence in the relative strength index on a weekly basis. We see a double divergence here. We see a higher high in price, but a lower high in the oscillator. And then again, a few months later, we see another higher high for a second time, but another lower low in the oscillator. So a double negative divergence there in 2007 helped set this key top, major top in 2007. So if we progress further here into 2013, 14, actually, 2013 into 2014, we start seeing this weekly negative divergence starting to develop again, where we've had this occur not just twice, but now, let's see, 1, 2, now 3 times, a triple negative divergence in the weekly RSI oscillator, and we're starting to actually see a downward channel in that oscillator now. So another cause for concern that we do actually have a significant top forming in 2014. We'll move on to sign number 4, which is a development of head and shoulders patterns throughout not just the American markets, but actually in some of the global markets, stock markets. Currently, while we're below this 17,350 high, we could be working on a right shoulder in this current up move, short-term up move. As long as we stay below that 17,350 high, it can be considered a right shoulder, and this is a neckline below. So if the market tops out below that 17,350 level and falls down and breaks below this neckline, we've got a lot of momentum here that could be flipped on its head and push to the downside for the Dow. And the same thing is taking place in the DAX right now. It's already taken out its neckline. It's basically strumming, fiddling with that neckline right at this moment. But it is in place. So we have the left shoulder, the head, and the right shoulder in place. Neckline is broken. So as long as we remain below the right shoulder, I suspect the next time we break into a lower low under this swing low right here, it can be a capitulative sell-off to the downside. Same thing is taking place with the Japanese Nikkei. We're starting to move, continue to move a little bit higher into this right shoulder. Once that's complete, it could fall down again, and if it breaks this neckline, we've got a lot of momentum that's in place here from the neckline to the top. All that pressure could be turned over and force the market to the downside, well into 13,000 or even lower. Okay, so that's sign number 4. Let's move into sign number 5. Back in during the 2007 top, You can see during this uptrend, we saw this fairly steady incline in the overall volume as we saw the price move to the upside. But right about here, we see this dip and we see this abnormal spike in the volume. This is the SPY S&P 500 ETF. We see that volume basically double what was the normal volume through this incline. So this was another sign, another warning shot, if you will, that the market was moving into abnormal movement territory and cause for concern. And we did actually see a higher high in the price, but you can see we saw a negative divergence with the even with that higher high, we see a negative divergence with the volume, meaning we're seeing a higher high, but the volume is not mimicking that same high. It actually was lower than this spike. So that was another indication of topping action. All right, so let's move forward into 2014 here. We'll zoom in right about here. There we go. So again, we see a little bit different than the rise into 2008 or 2007. We see the volume trickling down, but it's consistently moving to the downside. And now we see this abnormal spike on this move to the downside. So if we see a higher high or not, you can see how the volume is trickling to the downside the last couple weeks. And I suspect this week may be no different, where we see the volume dwindling as the price is pushing higher into the short-term move to the upside. So again, we're starting to see this negative divergence taking place during this abnormal volume breakout. Okay, that's sign number 5. Let's move to sign number 6. And this is what's been taking place in the VIX lately. The fear index, you've probably heard of it. It's basically an indication of what's taking place in the between the put and call ratio in the options markets. The puts, when the puts are heavy, basically it's puts are often used as an insurance policy against possible downtrend. So when the VIX is sailing to the upside, that means investors and traders are increasing their put exposure in the options market, and that causes the VIX to move to the upside. And during the advance from the 2002 low into 2007, we did see the VIX kind of move down in this very tight, gentle, sloping, range-bound move, while the price in the S&P 500 was moving up. And that's a sign of a healthy uptrend. Except right about here, in about 2005, late 2005, we started to see as the price was moving up in the S&P 500, we started to see the VIX flatten out. So we see that our first signs of negative divergence between the S&P 500 and the VIX. And right about here, we see our first initial spike, and then an incremental low below the flattening portion into number 3, stage 3. And then after stage 3, we start to see a breakout above what was the norm previously, right about here, right around that 23 level. We see this breakout into new higher highs into this point number 3. So we get the initial breakout, and then the pullback comes into and starts to develop a higher base for stage 5. And during that pullback from point 3 down into point 4, we actually started to develop we cinched our major top for 2007 right there at October 8th. And then we started seeing the price move down while this higher base was starting to develop. And then, of course, Lehman Brothers crash, we start to see this VIX soar into crazy highs. So the same pattern, though in a slightly smaller scale, is taking place again here going into 2013, 2014, where we see this calm move to the downside while the move is steadily moving upward. We see stage 3 with a flattening move in in the orange here. See this flattening move, and then we see the incremental low for stage 3. We see the breakout above what was previously normal movement right here for stage 4, and now we're anticipating a sideways base to develop, and point number 4 here could be the beginning of our major top, similar to what we had take place back here in 2007. That was point 6, and now our last point for last sign of topping action is the Shemitah cycle, which I've covered in a previous blog post. You're welcome to go back and review it. But this cycle has been fairly consistent in the last 2 iterations. So back in 2000, at September 30th, 2000, we did see a move down in the price, and that whole year from September 30th to September 18th, which is a Shemitah cycle, Shemitah year, if you will, from Feast of Trumpets to Feast of Trumpets, we saw this move to the downside. And just 7 days prior to the end of that cycle, we had September 11th, which was obviously the 9/11 terrorist attacks in New York and Washington. So that concluded the end of that cycle, and then we saw some follow through to the downside into 2002. Same cycle repeated 7 years later. It's a 7-year cycle, I should say. This 7-year cycle is repeated again in 2007 to 2009. We had the September 13th. Did see from September 13th, we did see 1 month later into October 7th, 8th, where we saw one more incremental high. From that point, we saw the move down in the market, basically popping the real estate and banking bust of that bubble, popping that bubble during that cycle. And then we see the fall through to the downside at the end of that Shemitah cycle. Right there, September 29th, we saw that monumental crash in the market that saw some follow through into early 2009, blowing apart that bubble. Now we have another bubble in play, and it's progressed steadily into a new Shemitah cycle for 2014 to 2015. The Feast of Trumpets blew its horn on September 25th, and if we zoom in on this, you can see right around that week we started to see trouble with this first sell-off to the downside, which has contributed to a lot of the signs that we previously saw in these signs that I pointed out to you previously. So this move up, it may give us a small incremental high. It may stall just below this key swing high. Whatever the case may be, if this cycle is going to continue in the fashion that it has previously, this move from September to September 2015 should be a negative move to the downside, with September 2015 possibly culminating into a major move of some kind, very possible to the downside, similar to what took place back here in September 2008. So these are the 7 signs of a possible demise for the stock market. I think it's wise to put yourself in a defensive posture at least, and consider possible short play to respect these signs. Obviously, nothing is certain If this market decides it wants to, is hell-bent on a rapid rise and shake off all this negative goings on in the technical side of the market right now, it certainly can. And so not a place to be complacent, but a place to be cautious. Okay, this is Quad G signing off. I hope you found this video blog update useful and informative. Please consider joining our forum and giving us some feedback, your point of view, and what you think's going on. That's it for now. Take care and adios.